Hello everyone, today we're going to talk about a topic that's making a lot of mainstream news headlines and for very good reason. It's something that probably most of you haven't heard about called the repo market. No, this isn't where some crazy guy with long hair and a dog and a big truck comes and seizes your car or your boat from your house. It's something to do with major financial institutions and big money moving the markets. Now, I couldn't do this alone because I don't understand it as clearly as I should, but I do have a resident expert, Bill Addiss, here joining us. Bill, thanks so much for helping us.
Pleasure to be here, Roland. Thank you.
So yeah, it's not someone coming and taking away my car because I missed my payments.
It is not.
It's actually way more significant than that.
Yes,
Walk us through what is the repo market.
Okay, and I should preface by saying the repo market is the largest trading market in the world that nobody has ever heard of.
Which is already crazy because,
Yes.
you know, I know our viewers are pretty well versed in financial markets, and, you know, we know bonds are so big and the equity markets and currencies. And the repo market may rival or be bigger than those.
It is. We estimate that the daily trading volume in this product that nobody's ever heard about is approximately 7.5 trillion a day.
Wow.
That's bigger than the FX market, that's bigger than the US equity market, and it is literally the financial engine under which Wall Street runs. But yet very few people outside our industry actually understand what's happening, let alone the problem that we're having now.
Right.
This has been in existence for decades.
Bizarre. And honestly, I did not know about this until we had the issue that we're going to show you here and talk about in a little bit. So walk us through this behemoth that runs behind the scenes, the Wizard of Oz, if you will, of the financial markets.
That's right. We'll pull the curtain back.
There you go. Show me.
The repo market, to understand it, is best looked at from the dealer community.
Okay.
These are the people, the dealer firms are the firms that go into the market to buy the bonds that are issued by our Treasury and by corporations for that matter. So we have this universe of bond dealers that have to commit billions of dollars to the marketplace almost on a daily basis to maintain liquidity in the bond market. And the way they finance this inventory, where do they get the capital to finance their operation, is through this product called repo. That literally what the bond dealers will do is they will take the bonds that they own and they will lend them to their customers in return for the customers being willing to lend them cash. So I literally would like you to think about this as a collateralized loan. Okay. The dealers go into the market, buy these bonds in mass inventory, take that as a collateral that they then lend out to their customers in return for borrowing cash. Now what happens on this transaction is, so on day one, the dealers lend their customers to their clients, institutional clients.
Right.
They
lend the bonds.
They lend the bonds, the collateral, in return for getting money. Now, literally, the next day, this transaction reverses itself. The next day, the dealers will repurchase the bonds, hence the name repo. Repo is just short for repurchase agreement. The dealers will purchase the bonds back at a slightly higher price, and that differential in price represents the interest the customer earned on the money. So the dealers buy back the bonds, give their customers back the cash. Now what happens is on that day, we start the transaction all over again. Because now the dealers have an inventory they have to finance. Now the customers have money they might want to invest the next day. Right. So we literally start this process all over again the next day.
So you got the dealers are buying large quantities. You mentioned billions. It literally could be in the trillions.
It is,
that these guys are being put in the institution.
Yep.
The customer here plays an important role, and I want to make clear that the customer is not you or me, right? It's not me coming in with $5,000 or $10,000, right? These are major institutions. Like who would we say would be a customer in this environment?
The best example is probably the mutual fund industry.
Okay.
Because if you think about it, every mutual fund keeps a cash balance. No mutual fund is ever 100% invested to meet liquidation requests. So if you look at the large mutual fund families like a Fidelity, a BlackRock, they have millions of dollars of cash on hand.
Okay, gotta put it to work somewhere.
Exactly. So they're looking at a repo as a very safe, very conservative, collateralized, one-day loan to get their money earning some rate of interest. You know, cash just sitting there is a dead asset.
Right.
But because their cash balances are changing every day, they really can't feel comfortable investing this for longer than one day. So from the dealer's point of view, they need to do this trade for one day because their inventory is going through such turnover. Bonds I own today, I might not own tomorrow. And the customers need to do this for one day because they're just getting their idle cash earning interest and their cash balances change every day. Right. So that's why this market is the largest trading, because literally it's almost like the whole market rolls over and rotates every day as a result of this.
So that customer, as you pointed out, they're loaning these bond dealers money. And it's not like they're buying these bonds. No. It's just basically collateral. So they're loaning money for a temporary period of time. The next day that money comes back. So they loan it out. The bond is used as collateral, as I just mentioned. So the illustration shows it going to the people's hands. It really doesn't do that. It's just a collateral.
Right.
At the end of that day, the next day, money comes back to the customer, and the bond, for all intents and purposes, stays with the firm.
Exactly.
The big problem here is the rates. So these big customers that you mentioned, hedge funds, mutual funds, whatever you want, they are using that large amount of capital that they have on hand and saying, look, I don't want to commit it for 6 months or 3 years or 30 years or 20 years, 50 years, whatever. It's overnight. And therefore, I know where it's, basically, it's small little, and I'm getting interest on it. And they kind of know what that rate's going to be, right? It's been around 2%.
It's been very consistent with the Fed funds rate.
Right.
Because if you think about it, the repo is a one-day, very conservative, collateralized transaction, collateralized by treasuries.
Right.
So the repo rate and the Fed funds rate have always slaved right on top of each other. That's traditionally been the relationship, which does mean in today's market, with short-term interest rates being so high, the repo rate has been rather attractive even before the crisis that we're going to talk about.
So visually here, let's take a peek at what happened. This is September 2019, and you guys can see that this is the repo rate. It's oscillating between 2 and 3, you know, and no major spikes. And all of a sudden, what on earth happened on the 16th of September? Because we went from 2 to 10. Right. And if I'm understanding you correctly, that means that the customers were now receiving 10%.
Right.
Versus 2.
Exactly.
I'm loaning out more. I mean, that's a major improvement for the customer, but that also speaks volumes to the dealer, because what happened? Why did the dealer all of a sudden have to pay 10%? And
literally what happened in September, as the chart illustrates, is the dealers went into the market to lend out their bonds, as they've been doing every day for decades. Yep. This is a market that just has operated. And what they found is that investors did not have enough cash to lend them the amount of cash they needed to finance all this trillions of dollars of inventory. We literally had a cash shortage. Now, if you think of cash as an asset, if something becomes scarce, what happens to its value? It goes up. Yeah. So what happened, as this chart illustrates in September, is after having consistently borrowed money at 2 and 3% for the last year, last month the banks, the dealers rather, had to pay 10% in some cases to borrow money on an overnight basis.
And basically just saying that there was nobody there to buy it.
Exactly. There wasn't enough money to go around. Right. There wasn't enough money to go around to buy it all.
Okay.
And we literally had a liquidity shortage. We literally, it is not an understatement to say, we ran out of cash in the U.S. banking system. We had a liquidity crisis. And the press picked up on this.
Sure.
You and I as investors might have benefited from this, because if you have a mutual fund that invests in repo like money markets, the yield on them has now gone up. But we are saying what's good news for the investor in this case was bad news for the dealers.
But also it reverted back to normal, because we had a white knight come in, right? We had, well, I mean, that's a white knight. We had the Fed who
they would like to hear you call them that.
Bails everybody out.
Right.
So the market, in a free market economy, this was a major issue. This is a serious problem, because if all of a sudden these major dealers can't find buyers for their instruments, there might be default problems and maybe an inability for them to continue to grow their balance sheets and grow, which means the economy becomes stagnant and stumbles. In that cash liquidity crisis, all of a sudden the Fed stepped up and said, nobody's buying, nobody has money for this, we'll buy them. Right. Now, to me, that's not fair. That's not right. But systemically,
we're going to have a fairness discussion.
But from a systemic point of view, it was necessary.
Yes.
Because had they not done that, who knows, we could have been at 12, 50, 20%, and then all of a sudden we have a major financial crisis.
Exactly. We call them a white knight. We do need a proactive central bank. And when they saw this phenomenon happening, they realized we have a problem here. And I'll give them credit, they responded quickly. And what the Fed has set up, that they're now going to roll into the second month, is the Fed has now stepped into the market and is doing repo themselves. In other words, they're putting liquidity into the market and pulling treasuries out. And that's increasing the amount of cash in circulation. So the Fed has been very proactive on this. They originally thought they would only do this intervention for a month. They've decided to carry it through to November.
And it'll be on through 2095
exactly.
at this rate, right?
They'll just keep kicking the can down the road.
As long as it doesn't ruin anything, because I think we figured this out with rates. Like, we cut rates to 0, right, for a long time, and everyone's like, hyperinflation's coming, it's going to be crazy. Nothing really happened, so they're kind of going, all right. At this point, I think they're trying something new too, because they haven't had to do this.
Well, they haven't had to do it for a long time.
Okay.
If we do go back, the important lesson here is that Fed did have to do this back in 06 and 07.
Oh, okay.
But for that reason, we had a problem in repo. But that was driven by credit. In other words, if you go back to the financial crisis, the banks had a lot of risk to them.
Sure.
And even under a collateralized loan, not a lot of investors were willing to lend money to the banks in the repo market.
Right.
You know, I'll go back to my former employer, Lehman Brothers. It is literally repo that killed Lehman Brothers because of the credit considerations. Right. Because what happened is on that third Friday in September of '08, Lehman went out to go lend out their inventory, as they'd done every day for decades, to literally find out no investors were willing to lend them the cash. And when when Lehman couldn't finance their inventory through repo, they went bankrupt. So it was back in '08, the Fed did a similar thing. They provided extra liquidity to the market, but they were doing that because of the poor credit of the banking industry at the time.
Right.
Now we have another repo crisis, but the motivation is very different.
Right.
Now it's literally a scarcity of cash.
Well, the good news
Believe
is
it or
the Fed
not.
just can print it up.
And that's basically what they're doing. This repo intervention, many people are calling quantitative easing light.
Yeah.
It's the Fed's way of getting cash in there on a short-term temporary basis, but they're still throwing liquidity into the market.
I got three things I want to go into. Number one, you mentioned Lehman Brothers back in third Friday of September in '07, right?
'07, rather, right.
Can we bring that chart back up here and see when this issue happened here in the U.S. in 2019? It looks like the third Friday of September.
Yeah.
I'm seeing a pattern here.
Black Friday.
The other part would be, you know, obviously back in the 2007-8 crisis, that was, okay, people probably spotted Lehman and said, well, we're not lending to you. We're not going to buy your paper. That's fine. I get that. Here was more systemic because the cash wasn't there. What happens if we don't have a buyer, if we don't have someone to step up and make that purchase and offload that risk to the dealers?
Right.
I mean, it's obviously a hypothesis because we're pretty sure the Fed's going to do it, but what if they don't? How does this impact you and I as retailers?
What we're going to see is short-term interest rates going up.
Okay.
That's the reality, that the repo market will kind of drag the other short-term interest rates up. And the Fed has much more been in a posture of wanting rates to go down in today's market. So I'm not sure that many people are looking for that, obviously, but that is the risk. Money is an asset like anything else.
Right.
If money becomes scarce, its value is going to go up. But that kind of interferes with current monetary policy. So the Fed's posture is much more, let's put liquidity into the market, trying to drive rates down, because as you said, we don't seem to be worried about inflation in today's world.
Bizarrely enough.
Bizarrely enough.
All right. Well, Bill, thanks so much for that. I appreciate it. Hopefully viewers understand a little bit better the repo market. This, the pulling back of the curtain, so to speak, I think is a very good thing to do because it's so big, it's so powerful, and it's something that happens every single day. And no matter who you are, it's impacting you on a daily basis. And just nice to know these things, how they function, how they might impact your personal investments and your finance. If you'd like to learn more, go visit OTAcademy.com and watch some more videos.